Welcome back, everyone, to my Stock Market Weekly Update series, which I post for you every Saturday. This past week was a bit of a roller coaster ride in the market with mixed results. We had popular stocks like AMD give weaker guidance, which spooked investors. We have continued drama with Elon Musk and the whole Twitter acquisition, and the global conflict between Russia and Ukraine continues to weigh on the market as well. So I'll be sharing my quick thoughts on all of that plus more, and we'll even take a quick look at the biggest gainers and losers for the past week as well. Should be an interesting one, as it always is. Hope you guys enjoyed this update, but with that said, let's go ahead and dive straight into this. Okay, and starting first here with a quick look at the markets, Monday and Tuesday really started off very strong for the S&P 500, which was great to see given that the 3 weeks prior were all declines, but on Wednesday, stocks returned to their typical falling ways with declines in each of those days following, leaving the index only up about 1.5% for the week. Again, though, this was the only week out of the past 4 weeks where the market actually finished positive. Overall, though, the S&P 500 is still well into a bear market, as it is down about a quarter of its value from its highs, and the other two major indexes are basically experiencing the same thing, with the Dow Jones being up and down for the week, but still in a bear market with over a fifth of its value lost from the top, while the tech-heavy Nasdaq also saw the same choppiness for the week, but is down significantly more than the others at about a 35% decline from the top, which I consider that to be a very significant crash. But crashing is really just what we've become accustomed to this year given all the craziness and madness going on in the world, which brings us now to the most recent market news. Now, on a more kind of macroeconomic level, the initial rise at the start of the week was mostly because manufacturing activity was down, which typically signals a slowdown to the economy. And the reason why the stock market actually likes that is because a slowing economy means that inflation will likely go down with it, and thus the Fed may not have to raise interest rates by as much as they, previously thought, which is what the markets always want. They always want lower interest rates since that means that borrowing money gets cheaper and thus companies are able to become more profitable and they can afford to invest in future growth, more easily, which ends up sending their stock prices higher. However, that optimism didn't last very long as the market proceeded to fall again in the later half of the week, especially on Friday, where labor reports showed that unemployment actually fell to a multi-year low of 3.5%, which indicates that people are still mostly employed, which means they will have plenty of income to spend, which means demand will stay elevated and thus inflation is not likely to come down. As a result, the market is pricing in more rate hikes from the Fed to fight off that inflation, despite us already being at the highest rates since the Great Recession. And the fear is that it will lead to our own recession if we don't get inflation under control. Well, to make matters worse, the global conflict between Russia and Ukraine is only adding to that inflationary pressure. As you've probably heard by now, Russia's Nord Stream gas pipeline was attacked recently, and rather than OPEC choosing to increase production of oil and gas to help compensate for that, they instead decided to essentially take Russia's side in the conflict, and they chose to actually cut production, which is going to send energy prices soaring once again, thus more inflation and likely continued interest rate hikes. Now, you may recall that energy prices were recently falling and they were finally easing a little bit of the pressure on inflation, but because of this cut from OPEC, well, they've risen back up to a 3-week high and will likely continue rising until solutions can be found or agreements are made. And of course, none of this will even matter if the world gets destroyed, which unfortunately is always kind of a possibility if like a full-out nuclear war was to break out, which by the way, Russia has somewhat warned already that they'd be willing to use those type of weapons if their state ever comes under attack or if NATO gets involved, which is kind of on the table right now since Ukraine is trying to take back territory that Russia recently gained control of and is now claiming as their own. Plus, peace talks haven't really gone too well because Ukraine has actually refused to negotiate in the past, saying that they would only negotiate if Putin was removed. And more recently, Biden even warned that Putin's warnings about nuclear weapons are real and they could spark Armageddon. Although the White House and Pentagon later clarified that they haven't seen any actual signs of those weapons being deployed. But still, we know that Russia also, they recently mobilized their super weapon submarine that can supposedly cause tsunamis on enemy territories. And the US has even purchased almost $300 million of anti radiation medicine, although they claim that it has nothing to do with Russia. And look, we could go back and forth on this stuff all day, but ultimately, what it all really comes down to when looking at the stock market is that we're left here with a ton of uncertainty, and that's going to mean continued volatility going forward and big swings in the market, both up and down. Because I don't really see the global conflict between Russia and Ukraine de escalating anytime soon. I'm still hopeful that it will eventually, but at the moment, things are looking pretty bad. And by the way, that's not something that I take lightly. Like, I feel really, really bad about everything that's going on and all the people out there suffering. And of course, my thoughts and prayers go out to anyone and everyone being affected. It's not easy for me to keep talking about money and stocks when there's people out there suffering, but it is my job here on YouTube to update you guys on what's going on in the market and stuff. So I'm just trying to do the best I can. But anyway, with that said, we have that going on. Of course, you still have the issues of inflation. Energy prices are making that even worse. And so we're likely going to continue to see elevated interest rates for some time as well. All of this is really bad news for the stock market. But if you are a long-term investor, periods of extreme volatility like this can sometimes present some great buying opportunities for some of your favorite stocks. And that's why I still remain a net buyer of stocks, even during all the craziness going on in the world, because I'm trying to think long term. So that's just how I feel about everything going on right now from an investment standpoint. Anyway, with that said, let's go ahead and transition now to any individual stock news that happened this past week. I'll let you know if anything caught my eye. And then we'll also wrap up the video with the biggest gainers and losers in the market for the past week too. And I'll let you know if anything caught my attention there as well. So let's go ahead and talk about that now. Okay, so in equity news, popular chip developer AMD, they came out and they warned that revenues will be coming in lower than previously expected, citing weaker demand in the PC market as well as overall supply chain issues. This caused the stock to crash by over 13% just on Friday alone, while also causing fellow rivals like Intel and Nvidia to fall by over 5% and 8% respectively as well. I don't personally own AMD, but I do own Intel and Nvidia, and I do actually think that with these stocks trading at 52-week lows, any future dips from here are good buying opportunities, in my opinion, for the long term, because I feel that weaker demand in the PC market is to be expected given the really hard comparison to these last prior years where the pandemic sent demand soaring because of people staying home and an increase in remote work and remote learning. So a little bit of a correction, and I think that's normal. And I also expect supply chain disruptions to eventually dissipate as the world opens up more, even though we are still definitely feeling some lasting effects from it, especially in China, where the stricter zero pepperoni lockdown policies continue to weigh on popular Chinese stocks that already had a horrible month in September. Many of those are down like half their value or more, including some of my personal favorites like Alibaba, Tencent, and Baidu. In my opinion, though, all of these companies still have a lot of long-term potential, so I remain a buyer on future dips. Moving on though, Elon Musk was also in the news as he continues to fight back and forth with Twitter over his proposed acquisition. As you'll recall, Musk originally offered to buy Twitter for $54.20 per share, but later put the deal on hold because of concerns over how many fake accounts Twitter has and whether they were telling him the truth about those numbers. This was later being dragged to court though, because Twitter wants Musk to buy the stock since the market had crashed and the original offer that Musk made was actually worth a lot more than where Twitter would be now. However, Musk came out this week and he resubmitted his original offer in order to avoid court and excessive legal fees. As a result, Twitter stock shot up again, climbing by over 20% just on Tuesday alone, but after a few red days, it is still about 10% away from that closing price, which I believe the acquisition is set to go through in a couple weeks. So some investors are, they're probably betting that the deal will get done and they're hoping to make some profits on it. Even from here, you can still make like about 10% profit if it gets done. For me, it's too volatile of a situation. There's too much drama going on. It's hard to predict. So I don't really feel that the reward at these levels is high enough to persuade me to jump into Twitter at this time, but I do enjoy, watching it from the sidelines. It's very entertaining. Anyway, speaking of Elon Musk, Tesla, on the other hand, they got crushed this week, falling by over 15%. And there's a couple reasons for that, but part of it was also because Elon will need to sell some shares in order to pay for the Twitter deal. From its highs, though, Tesla's stock has now lost almost half of its entire value in what has been a very large crash. At this point, I gotta say, Tesla stock starting to look pretty attractive again. But if you want to know more about the risks and concerns for investing in Tesla right now, I highly recommend that you watch the last video that I just put out, where I outline all of the different concerns that I have with Tesla stock. By the way, Tesla is currently my third largest stock in my entire portfolio. Moving on though to the biggest gainers and losers for the week, starting with the gainers, we look at the more popular large cap stocks, and this week, there's not really much to say here. The list is almost completely dominated by oil and gas energy companies, including Matador, Apache, Murphy, Marathon, Halliburton, Cenovus, Ovintiv, SM, and Devon, all climbing by around 20% or more for the week. Personally, I've never been a big fan of oil and gas stocks because I kind of struggle to time them correctly in the short term, and then even over the long term, I'd prefer a more pure play renewable energy stock if I was forced to own one. However, I will say that out of all the oil and gas stocks out there, my favorite would probably be Chevron, just because they have a fantastic dividend that already yields 3.5%, despite having a very low payout ratio while also being grown for 3.5 decades in a row. Plus, given the rise in oil prices, Chevron's financials have been soaring, with revenue growth of almost 50% expected this year, which they're using to make bigger investments into renewables, as is clearly evident in the recent acquisition of Renewable Energy Group for $3 billion earlier this year. Anyway, moving on to the biggest losers, the worst performer was Maravai Life Sciences at over a 22% drop, which is a biotech that barely IPO'd in 2020. And they do a lot of work with mRNA technology. They help other companies with their V shots. In fact, their two largest customers, I believe, are Pfizer and BioNTech, who of course are famous for their version of the pepperoni V-shot. Originally though, the stock skyrocketed because of the pandemic, but ever since then, investors have been selling out of it as we move past the pandemic, and it's been crashing ever since. It may be a high flyer once again during maybe another pandemic, but right now their earnings per share are expected to fall by around 17% on average going forward, so most people have been selling out of it. We also saw AMTD Digital fall by almost 20% again this week, which is the super sketchy Chinese stock that is often featured on our list, but as I've told you guys many times, they're way too shady of a stock for me personally. Speaking of China though, like I mentioned before, many Chinese stocks have been getting hammered this year, and this week a bunch of speculative EV stocks took another hit, with XPeng, Li Auto, and NIO all falling by around 12 to 17% respectively. Now, NIO is by far my favorite of the bunch here, and I actually used to be invested in NIO myself, but I've been waiting for a good opportunity to jump back into it because I think they have a lot of future potential as a spec stock with really impressive vehicles and similar technology to even that of Tesla. And while they are based primarily in China, they've recently been doing an amazing job of expanding super aggressively, with the recent launch in various countries throughout Europe and an eventual plan to enter the United States market as well. Currently, the stock is already down more than half its entire value just this year alone. And I gotta say, man, I'm getting super close to buying this stock, especially if it keeps falling like this, like into the single digits. It's getting super attractive, but I'll probably make a whole dedicated video on it soon for you guys. Let me know, by the way, if you'd want to see another deep dive on NIO stock. I think it'd be a fun video to do for you guys. Anyway, speaking of EVs, Tesla, of course, fell by over 15% this week, which we already talked about. And then the only other stocks that really caught my attention a little were, I guess, DocuSign and H&R Block. H&R Block is, of course, the tax specialist company, which fell by over 10% this week, but I actually like the TurboTax parent company Intuit. I like them more because of their higher growth and their larger focus on online filing and different things that they do. But when looking at DocuSign, that's a stock that I might have to start researching more because they fell by over 10% this week too. And they're now down by around 85% from their highs, which is a massive crash. And if you don't know about them, this is that e-signature company that helps businesses with signing agreements and contracts digitally. You've probably used them before to like sign some document, digitally. And they also help with various other things. They do like cloud file management, organization, and they even help companies with various HR services too. But I think it's a great business because I see the world becoming more digital over time, and that's why their sales can sometimes fly by huge amounts. However, investors have been selling out of the stock recently because they're not currently profitable and their revenue growth is expected to slow down coming off of the pandemic where so much work and organization was being done online. Now, though, growth is expected to decelerate to around 17% this year and then drop to 10% next year. Valuation wise, they have a PS ratio of 4, which I think is still too expensive given that smaller revenue growth. And that's why I still haven't really purchased the stock myself. But I think longer term, this could be a very profitable company with really high software margins once they get the ball rolling. So it might be a stock worth keeping an eye on. Anyway, that's going to do it for this week's episode. Let me know what you guys think about everything we talked about in today's video down in the comment section. I'll read and respond to your comments as well. And I hope you're all doing well out there with all the madness and craziness going on in the world. But thank you for stopping by. Thank you for all the support. And I'll catch you in the next video. Take care. Bye-bye.